Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we've got some great things to cover for you to make you a smarter investor. Going to talk about the inflation report that likely says, yes, a Fed rate cut will be happening this month. The bank earnings from last week had some surprising undertones. We'll discuss that, what's going on there, kind of surprising. And then also, too, we got to go over this one. Risky investment behavior continues to amaze me. You just will not believe some of the things that go on behind the scenes that I do believe will eventually kind of blow up on investors like they always do, going back in time. So,
yeah, and I was going to say, I mean, some of it doesn't go on behind the scenes. It's just people, I think, are getting greedy, but
yeah.
Well, we'll talk about it.
We'll talk about it. And that's Chase Wilsey, by the way. I don't think I introduced you.
No, he didn't. It's all right. I think people might know, but sometimes people confuse the voices, but
Yes.
it's all right. But companies we're looking at today, that's going to include, we're going to look at Progressive, the insurance company. I always see their ads. You got Flo, you know, the spokesperson.
Oh, I
for
forgot
it.
about her. Yeah. Wait, I thought she is progressive.
She's Progressive.
Okay.
Yep. I also got Bank of America Manpower Group, which is a staffing company. And then lastly is Snap-on Tools. So, you know, I think we got some different companies here. Nothing really, I'm going to say, overwhelming in the tech space. So maybe we'll have some value opportunities today in the back half of the show.
We'll get that last one done in a snap. So.
Hey, maybe. We'll see.
Right. Well, let's talk about the risky behavior continues just to amaze me, Chase, a lot of smart people in the industry, because many people point out that we have missed the boat on crypto. But I continue to worry about the space long term, as there is just no true way to value what these cryptocurrencies are worth. While this is a major concern for our firm, I would say leverage in the space is another major risk. You never even thought about the leverage, but it is out there as well. A big problem is the rules and regulations, and ultimately the transparency is not as clear as when you invest in public companies. There's so many things behind the scenes here, behind the curtain, that people don't realize, and it's just another risk added on top of risk.
Yeah, and I always think it's funny when you listen to people and the way they get their target sell price on Bitcoin is like, well, if everybody buys 1% of Bitcoin in their portfolio, it's going to be worth this. And it's like, you could say that for anything.
Yeah,
if everybody buys 1% of JPMorgan Chase in their portfolio, it's going to be worth this. It's like, it just makes no sense. And we talked a lot about gold last week, and to me, cryptocurrencies are even worse than gold, because at least gold, you get the shiny piece of metal. With cryptocurrencies, there is, again, just no way to value it. No earnings, no cash flow, no interest. It's just not possible to really come up with an intrinsic value of what cryptocurrencies are worth. And you mentioned the leverage, and this is what really, I'm just going to say, was jaw-dropping to me. I read an article on CNBC, and the leverage was insane, and I bet most investors have no clue about it. And, you know, there are ways to leverage crypto here in the U.S., but the offshore market is where things just get wild. And you have to remember, obviously, cryptocurrency is a global asset class, right? You know, people all across the world are buying it, essentially.
Yep.
So that can move the needle. But offshore decentralized exchange Hyperliquid offers maximum leverage, you ready for this, of 40 times for Bitcoin and 25 times for Ether. And then Binance Labs linked Aster, again, another offshore decentralized exchange, offers as much as 100 times leverage, depending on the token. I mean, it is just crazy, the things that people are doing in cryptocurrency. And the reason it's so dangerous is because if a decline comes and investors need to unwind a position, it can create a cascade of selling that leads to massive losses. And it doesn't even just need to be a little bit of a loss, right? If you have double leverage on something, you can withstand a little bit of a loss before you get that margin call. But 100 times leverage, I mean, you get a margin call if it's down maybe 5% because you are so over leveraged on that.
Right. And 100 times it's just ridiculous, because your loss will be high. And the problem is that leverage has destroyed almost every major investment of time. 2008, what happened? The banks were so over leveraged because they're doing all these crazy loans and so forth. People were over leveraged doing these loans. That caused a problem. Every time you look out and there's a major bust, it's because of leverage, where people get overexcited about these things. And you said 100 times. So if I put in, maybe sure I get this right. So if I put in $1,000 as a deposit, I can leverage up to $100,000 and make that investment $100,000.
Yeah, so you'd buy $100,000 worth of Bitcoin essentially.
And so Bitcoin went down 1%. I just wiped myself out.
Yeah, I guess. Yeah, and I mean that's the crazy part, right? Where and this is also inflating the market, right? Because you don't need $100,000 to buy Bitcoin, and I think there are other cryptocurrencies that have different markers. I'm not sure if Bitcoin you can leverage 100 times on Aster, but they just kind of pointed that out. But again, using that example is you put in 1,000. Well, now you get 100,000. So now you're pumping $100,000 into Bitcoin, and multiple people doing that. It's artificially lifting the price of Bitcoin because there's so much leverage in the space that there's really not, again, $100,000 worth of solid money in Bitcoin. There's one person that is crazy leverage in it that is, again, artificially almost lifting the price of that cryptocurrency.
And people don't want to hear it because like, oh, no, you're spoiling the party. It's just like leverage is not good. Whenever you have that type of leverage, even, and I think the banks back in 2008, I think I remember them being like 14-1. And when the collapse happened, was it Shearson Lehman, I think it was. Not BlackRock.
Well, Lehman Brothers.
Lehman Brothers, that's what I was thinking. Lehman Brothers, and there was another big one too, Washington Mutual. They were picked up by JPMorgan. So you get that domino effect where things just keep falling. And it's not just crypto market where people are gambling, though. We saw the return once again to the meme craziness with Beyond Meat producing massive gains of, this is one day, Monday, 128%, Tuesday, 146%. On Wednesday, the stock at one point produced another triple-digit intraday gain, but it ended up closing down 1% for the day. And when you look at the week, I think it started Monday, somewhere around $1. I think it was Wednesday, was very close to $7 a share. Friday closed at $2.19. How many people lost money because they bought in at $3, $4, $5, $6 a share, thinking, oh, this is going crazy, and that closes. This is just I think your odds are better in Vegas than they are playing with these meme stocks.
Well, I mean, you look at Beyond Meat. I mean, the reason it got so exciting, and there wasn't really much to it, it was that Round Hill meme stock ETF added them to their ETF. And that's what kind of started this whole process. And they announced a deal with Walmart to expand distribution to more stores across the U.S. So, yeah, I mean, that's a decent positive highlight, right? But definitely not to the magnitude that we saw. But again, the big issue is that short squeeze. More than 63% of the shares available for trading were sold short. So that's what kind of, I think, attracted people to it. And the funny thing is, this comes after last week. So not this most previous week, but last week, the stock tumbled more than 67% because the company announced it finalized a debt deal. So this business is taking on more debt. I think the fundamentals are deteriorating. And last week, it ended at 65 cents. So, I mean, yeah, it's up to $2.19 for the week. So you did pretty well if you bought it on Monday, or let's say last Friday, but it is just insane. I wanted to point this out too, was you talked about that Wednesday situation. At one point Wednesday, the high was $7.69 and it closed at $3.58. So that means somebody lost essentially 50% of their money during that time period. And then if they continued to hold, they said $2.19, not good. And the high for Beyond Meat was $230. I mean, this is just, again, a crazy, crazy company that has no business being up what it was up this past week.
And that's those meme stocks. Again, it's
not
exciting. It's not investing. It's just craziness that it's gambling.
Yeah.
Pure and simple.
And the last kind of instance of gambling that I saw this last week, and I was blown away by this, was nuclear power development company Oklo had a sizable pullback after the Financial Times noted the 500% advance in 2025 and $20 billion market value has come despite, get this, no revenues, no license to operate reactors, and no binding contracts to supply power. Now, if that's not a gamble, I don't know what is. And when you look at all this behavior, I mean, generally things like this happens when things get frothy and people start to reach and they get in over their heads. And I think that's exactly where we are today. And it's just another signal of risky behavior in the market.
And that kind of reminds me of the biotech where, sometimes biotech companies just go crazy. They have no contracts. They have no no earnings, nothing, and just because the potential of what it can do, they'll go up dramatically. Well, 500% advance, is just crazy with nothing there. But people, and nuclear does look like it's coming online down the road, I'll say. But it's just like to invest that much money that quickly, it's probably not going to be this company. That happened a lot during the tech boom and bust. A lot of companies like, oh yeah, they're going to be part of it. They weren't. It was your bigger companies that actually did it, not the smaller companies.
Yeah.
So, all right. Well, let's talk about. You want to talk about bank earnings?
Let's do it.
Yeah, because they came out last week and they did have some surprising undertones. And overall, the third quarter report from the big banks, showed things are pretty much going along okay. Not great, but not bad. But then a couple of the big banks brought up the issue of private credit and some bankruptcies that led to write-downs. Jamie Dimon, the CEO of JPMorgan Chase, pointed out that even though he said he probably should not say this, I like this, is that if you see one cockroach, there are probably many more. And we've talked about private credit, private debt, private equity. This is going to be something that, again, is going to blow up on people. And it's like that's the hot thing to do now. It's not going to be because of, that word again comes up, leverage.
Yeah, and I think, we hit this on the show last week, but it's so important as the week progressed. This week, there was more information that came out that we wanted to bring it up again because it is something that I'd say is very concerning. I mean, the numbers here don't sound that concerning, but you dig down deeper, there's some underlying tones, as you mentioned, that you might want to watch out for. And as again, the numbers that I'll bring up here, the smaller financial institutions like Zions Bancorp and Alliance Bancorp, they took a $50 million charge and a $100 million charge respectively due to potentially fraudulent loans. The issue here is commercial banks have been making loans to non-financial depository institutions, or NFDIs. And I point out that this type of funding is not very transparent for investors to see what is going on behind the scenes. It's, again, something that you don't really know there's a problem until it's over. Yeah. It's like, shoot, we have a complete write-down because that was a complete failure. And, the thing that just gets me is the one that's really been prominent here was this company Tricolor. And, this hit JPMorgan Chase as well, but it didn't really move the needle because obviously they're trillions of dollars and it was in the 50 millions or the 100 millions.
I think it's 170 million, I think.
Yeah. It doesn't really move the needle for JPMorgan Chase, but it makes me question the lending that might be going on behind the scenes. This Tricolor company, let me ask you, is this a good idea? Would you do this? They lent money to people without social security numbers, no driver's license, and customers with no credit history. Now, that sounds like a safe lending practice, doesn't it?
Let's get on board with that one, And these are the things, and again, we said Jamie Dimon is very conservative, but again, it's like $1 trillion bank. Yeah. There are so many people working for him that you've got, I'm going to say it, aggressive brokers out there that they're just trying to get their bonus. They'll sell to anybody. They'll do things where like, no social security number, no. That runs at 2008. No revenue, no earnings. That's okay. We'll still loan you money. So we're getting back to that. And what happens when you get this froth in the market like we have now, that brings back on the craziness, which creates that bubble, and everything pops. And people say, well, what happened? We're explaining to you now what happened. So be very careful investing. And let's talk more about these NFDIs, because I was surprised to learn that these NFDIs now account for roughly 1/3. That's 33% of commercial and industrial loans originated by large banks. That's frightening. One may think if you're invested in AI companies, well, hey, I'm safe, But research has shown that even your deep pocket players of AI are funding investments with these private loans. Think about that. Deep pockets are still using these crazy loans. As time passes, the more I read, the more I become concerned about what we don't know about leveraging the economy. That's the problem with private. You don't know what's going on behind the scenes, and why this has become such a big thing. I know why. I was going to ask why. It's because Wall Street. Wall Street can bank billions, maybe trillions of dollars on this, where the small investor once again gets burned because they didn't know what's going on behind the curtain.
Yeah, and I was reading right before the show, so I didn't have time to look and see if they're the same exact things. But there's these terms that keep popping up, and another one was non-bank financial institutions, and I don't know if that's the same thing as NFDI or the different acronym there. Right. But when I was looking at this research as well on the NBFIs, which is again the non-bank financial institutions, loans to these entities reached some $1.2 trillion as of June 30th, representing 10% of total bank loans, up from 3% in 2015. Industry-wide loan growth to NFBIs averaged 11% annually over the past decade. but was far faster at 35% a year among banks with assets between $10 billion and $250 billion. So we've kind of talked about, hey, maybe there's some opportunity in regional banks.
Right.
If they're lending at a high capacity to these NFDIs or the NBFIs, whatever that acronym is, you got to be very careful here. I mean, did we not learn our lesson back in 2023 with that mini banking crisis where we saw, the issues with First Republic?
22. Wasn't it 22?
I think it was 23.
Was it 23? Okay.
With First Republic and then, Signature Bank, those banks folding, I mean, you could very easily see another situation like that where you have a run on money because people start hearing about these loan write-downs. Like, oh my gosh, I got to get all my money out of that bank because it's not safe. And then it cascades and causes problems like, again, we saw in 2023. I think there is a lot of issues here going on behind the curtain, again, so to speak, that could cause things to blow up in the financial system.
And what could have caused 2023 was back in 2022 when you had rapid inflation, rates went crazy.
It's crypto.
Yeah, crypto. I mean, everything just, and that was like a small example. That was fixed pretty quickly because the government said, oh, we'll cover all the things. Eventually, the government can't cover everything. You've got to make sure that what you're investing in is not risky because it's just, you lose your money. Many people have a good amount of money of their retirement in these crazy investments thinking, oh, I'm doing great. It's like the merry-go-round goes round and round. It goes so fast, eventually you get thrown off it.
Well, and my problem is you keep hearing in the media, right? Like, oh, this is it's a contained situation. It's not widespread, but we don't know if it's widespread or not because, again, it's all in private money.
Right.
And again, the one example we have so far, it makes no sense why these banks would have given money to a company to lend it out to people with no social security numbers. What other examples are there that are private that are just like, oh, yeah, I know this is a one-time event, and it's like, how many more of these are behind the curtains that we don't know about yet? That is what concerns me. And the other issue with private credit, remember how they get higher rates, is they also leverage that credit on top of it.
That's right.
So, I mean, you have this huge leverage pool of money that could be very, very dangerous. And I hope I'm wrong, but there are some huge concerns that I have within this space.
And you know what else could happen is that the ones say, oh, it's contained, don't worry about it. Those could be the same people that are valuing the loans and so forth. That's private. So they're saying, yeah, everything's fine. You won't know until like first, Tricolor.
Yeah.
And I think there was another one too. First Leasing, wasn't it?
It's First Brands.
First Brands or something.
Some auto supply company.
Until things get really bad, that's when you find out things are really going on. But the people saying, oh yeah, it's fine, don't worry about it. They're saying that because they're probably making a lot of money in fees, don't want the party to end. But again, things will eventually come out because it's just, you can't keep leveraging and be okay. So let's move on and talk about inflation because the inflation report does say that, yeah, it looks like we will have a Fed rate cut at this month of October here. The September Consumer Price Index, also known as CPI, showed inflation climb 3% year over year for both the headline and the core numbers. Core CPI, which excludes food and energy, came in better than both the estimate and the previous month's reading, which both stood at 3.1%.
Now, this was a little bit of a surprise to get this data since the government has been shut down. But since it is used as a benchmark for cost of living adjustments and benefit checks by the Social Security Administration, it was a rare economic point in an otherwise quiet period. I mean, we haven't gotten this economic data in weeks during the shutdown. And also with this, I thought I'd bring this up. If you are on Social Security, it looks like you will be getting a COLA or cost of living adjustment of 2.8% in 2026, which is above the 20-year average of 2.6%. So
I'm kind of wondering who put this together. If the government employees aren't working, who put it together?
I thought they pulled some people back. Now, I don't know how they do that during a shutdown. Beyond me, the whole political sphere is a mystery to me.
Yeah. Energy, which provides such a benefit to the headline numbers for many, many months, has started to kind of reverse course as it climbed 2.8% compared to last year. Gasoline, still a small benefit, and it's true at the pump. I have not seen prices drop a lot, but gasoline was down about 0.5%. But a surprise, energy services climbed 6.4%, thanks to the increase of 5.1% for electricity, and an increase of 11.7% for utility gas services. Who are raising these prices? What is going on here? This is crazy for utilities.
I've talked about this before as well, but I'm going to point it out again. And concern I have with electricity and utility gas services, everybody's all excited about utilities because they're supposedly going to, benefit from data centers. We don't have many data centers online yet. What the heck is going to happen to energy prices when these data centers start popping up? We haven't solved the issue of the grid. So,
and I think, didn't we report like months ago that to build a utility, electric or gas, whatever, I mean, it takes a couple of years when we take into account the regulations, the permitting, everything else. It could take years to build those. What is going to happen? You're right. When these AI start coming on, people are going to be paying huge amount just to heat their homes and put electricity, turn a light on at home.
Just because we want it doesn't mean we have the infrastructure for it. And
True.
we might have now the infrastructure for the data center, but do we have the infrastructure for the energy of the data center?
Yeah.
That's a big question mark. Other thing, too, to point out here is when I look at tariff-impacted areas, well, it's actually still remained quite muted. You look at apparel prices, they fell 0.1%. New vehicles, that's kind of shocked me considering everything I keep hearing about the average price of a new vehicle, the loan amounts on new vehicles, but they were up just 0.8%. And food prices, they were maybe the hardest hit group. They saw an increase of 3.1%. But within that, food away from home was up 3.7%. And food at home was a little bit more muted at 2.7% increase. Food away from home, I think, could still be suffering from, different regulations, different wage increases. So there's more that goes into that than just obviously the tariff component of what you're paying for, your beef, chicken, pork, bananas, apples, all of your fruit and veggies. Got a lot on there. But
I think it may be slowing down, but it does seem like when I still go to certain restaurants, we're booked tonight, call us tomorrow night. So there's still a lot of restaurants doing well, but I think I am starting to see a little bit of slowdown. Maybe people going out to the restaurants. But shelter inflation remained above the headline and core numbers at 3.6%, but is much less problematic than it was in prior periods. And another positive was owners' equivalent rent climbed 0.1% compared to the prior month, which was the smallest month-over-month increase since January 2021. And we've talked about this equivalent rent where it really was actually making inflation too high, and we talked about that. I'm kind of thinking now, we got inflation, what do we say, 3% or whatever. This has come down. So maybe we almost have real inflation now, which we are nowhere near that target of 2%. So we could be in a little
That's where it gets interesting. I mean, when you look at the market pricing for these Fed meetings, and you kind of led with this, but after the report, the odds for a Fed rate cut next week already now stood above 85%. And then if you look at December, well, now that actually popped about 98.5% following the report. So people are looking for, again, 2 Fed rate cuts as we exit the year. Is that right? I don't know. With 3% inflation, it's something that I'm still unsure of. Are we cutting rates too quick? Is it going to goose the economy too much? And then now we're going to have maybe an inflation problem again in 2 years. I hope not. But, I think this is how things appear to be shaken out, is that we'll get 2 more rate cuts as we exit the year.
Yeah, and I know that's what the experts say. And again, you point out, is it right? Is it not right? I got to say, because once you shoot those bullets out of the gun, you can't put them back in. Yeah. And we could be in for a difficult situation. So we'll see it. Again, that's only the short-term rates. Again, big difference to the long-term rates. But that means your credit cards, your HELOCs, I think your auto loans, they'll drop. But your longer term.
So will your savings rates, which is unfortunate for many people.
Yeah, that money market that was 4% is probably now like 3 and 3/4 maybe. We'll drop to 3.5, maybe 3 1/4. So those be coming down. And I remember too, we did a report. I don't think we talked on air. We did it on our newsletter, where actually that interest income really hurts the economy a lot, because I forget the billions of dollars that people get in that. If they get less on that, they're going to spend less.
Yeah, think about your retirees, your baby boomers, which have a lot of the assets. This cut hurts them more than it helps them, because many of them already have your 30-year fixed mortgage, if any mortgage. So they're not really looking to borrow more in retirement anymore. They're looking to save money in a safe place. And all of a sudden it's like, oh, shoot, I lost my 4% yield. Again, there's pros and cons to the cut.
All this information does come from our newsletter, smartinvesting2000.com. Again, that's smartinvesting2000.com. Other topics there, what signals you should watch if you're holding gold. Lay's potato chips will become healthier. Also, too, the government thinks it's okay for some fees in your investments to be hidden. That's all the newsletter. Goes out every Friday at 5 o'clock by email, smartinvesting2000.com. So you ready to address the company?
Let's get into it.
Let's tear it down. Let's look at the Progressive. I wonder if Flo is listening here.
I don't think so, but
Probably not. Let's talk about Progressive. Their symbol is PGR, and that is Progressive Insurance. They own the insurance, property, and casualty industry. Only 1.1% shares on the short side. That's not bad. Institutional ownership's 88%. They've got a pretty decent PE of 12, but the industry is actually below that at 11.4. Price of sales 1.5 versus 1.2. And again, these are valuation ratios. You want them lower than the industry average, not higher. That's a better buy. Price to book value 3.6 versus 1.8. Price to cash flow 7.7 versus 7.2. And unfortunately, no PEG ratio there. I'm disappointed with that because the PEG ratio tells you what you're paying for the future growth of the company. That's your PE divided by the growth. We do see the earnings per share over the last year for Progressive up 29%. That's well above the industry growth at 7.8. Sales for Progressive up 14.5. That's about 3 times the industry growth at 5.7. Unfortunately, the analysts give a 5-year earnings per share growth estimate of only minus 0.2, but the industry is at minus 21.9, so not good for the insurance industry. Progressive does pay a 2.2% dividend, using 27% of their earnings to pay that out. Let's take a look at the balance sheet. And again, this is an insurance company. Financial companies are a little bit different than your normal company. There's no current ratio. We do have a debt to equity of only 0.2. That's the same as the industry. That is good. Net profit margin for Progressive does check in at 12.7 versus 10.6. Return on equity is very good at 32. And return on invested capital also good at 27. They have a nice free cash flow. We like that free cash flow. That's money coming in they can use. $16.4 billion, double the industry at $7.4 billion. Chase, what do you got?
Yeah, so current price here for Progressive, again, their ticker symbol is PGR, $219.09. The 52-week range, the low here, $217.20. Closer to that than the high that we saw of $292.99. Now, if we go forward for Progressive, we go out here to December 2026. I see estimated earnings per share is $16.41. I get a target sell of $272.41. That's an estimated return here of about 24%. So it wouldn't quite be in the buy category for us. It would still be a hold. But the interesting thing here is you got to watch out. There might be earnings revisions going forward. It looked like they tumbled about 8% last week after reporting earnings of $4.45 per share. That missed the estimate of $5.04. I guess a major factor that hurt it was a policy change in Florida that caps an insurer's profit.
Oh, we talked about that in the newsletter. I think it's coming.
Haven't gone out yet, actually. That should be in next week's newsletter.
Okay, good. And I did notice, too, on Progressive, the range of analysts is very high. The low estimate is $12.84. The high is $20.25. That tells me a lot of uncertainty about that $16.41 earning for 2026.
And I'm kind of surprised Florida came out and capped profits, but I know that they've had some huge issues over hurricanes and insurance just skyrocketing there. I mean, it's a difficult state to insure.
Can't control business. So, all right, we're going to take a quick break here. When we come back, we're going to talk about Bank of America, Manpower, Snap-on. So stay with us. You listen to Smart Investing Show with Brent and Chase. We'll be right back. All righty, welcome back to the Smart Investing Show. I'm Brent Wilsey, and with me now, and is obviously Chase still with us, but now stepping into the studio is Harrison Johnson, our financial planner, CFP. Harrison, thanks for being here today.
Always good to be here.
And we're talking about, I like this one, the real cost of financial mistakes. I think this could be a very big number, if I'm not mistaken.
Well, in this case, I don't have an actual dollar amount. I wanted to more talk conceptually about it because, everyone wants to make the right financial decision, obviously, but sometimes it's more important to avoid making the wrong decision, avoid making mistakes because, the value of mistakes add up and compound over time. And I would say, the definition of a mistake financially would be choosing from a set of alternatives, one that doesn't create as much output as another. Right. So that doesn't necessarily mean a decision is causing you to lose money. Maybe it's a decision where you're just not making as much money as another option that you had available. And this can be a broad, number of things like not taking retirement withdrawals and structuring income in retirement, and that causes you to pay more taxes and IRMA premiums. maybe have too much cash, so you're not letting that cash work for you, or maybe you have, too risky of investments, and you're putting yourself out there where you could lose and then not make that money back, or a lot of people make decisions based on their emotion, and selling at a bad time during a downturn, or chasing hot trends and that causing you to lose money in the long run, or not making the right decisions when you structure mortgages. All of these, whether it's assets, debt, cash flow, taxes, they all have an impact on you, and if you're not making the right decision, you're just making your life more difficult on yourself, which no one wants to do.
No, and as a fee-based financial planner, you're not selling product, not selling annuities or insurance or anything else. I mean, you're looking at these things for your clients, and you can actually question them unbiasedly because of the fact that you see something that's kind of risky, they're going to do something kind of risky, saying, I don't know. There's no benefit for you saying yes or no, other than you being paid a fee to give them the best advice.
Yeah, I'm perfectly positioned to tell people, this is what to do, and also these are the things not to do, and here's why. Because you're right, I don't have bias one way or another. How somebody structures a mortgage makes no difference to me. How somebody takes withdrawals from different accounts makes no difference to me. So I can truly look at the impact and say, this is the right way of going about doing it. And, the value of that decision plus the value of that decision plus the value of that decision, it all adds up. And if we can just be smarter, it makes life a whole lot easier, because we're getting our assets to work for us better. We're avoiding, the costs and extra taxes and opportunity cost of making not the right decision.
I would say, too, the nice thing with financial planning in a lot of cases is you kind of talk about structuring a mortgage, right? It's very black and white on the numbers. Like, you do it this way, this is the cost. Where I bring that up because investing, there's always an infinite possibilities of opportunity cost, right? It's like, oh, well, if you would have bought NVIDIA and put everything into it, technically that is an opportunity cost. And I just bring that up because investing, there are so many question marks. And that's what we try and do, obviously, is reduce risk as much as we can as possible. But with your situation, there's a lot of mistakes that people make that are extremely unavoidable. And if you just look at the numbers, again, they're black and white, you can really prevent a lot of mistakes, even outside of the investment landscape, where things are, I'm going to say, a little bit grayer, because there are a lot more uncertainty in terms of what the numbers will be.
And the financial planning impact or piece of that investing puzzle is, well, how much money should you be investing of the assets that you have? How much cash should you be holding of the cash that you have? Where should that be, so it's at least earning something? Of the money that you're going to be investing, what types of accounts are you going to be investing into? When you're withdrawing money, which of those accounts are you going to access? What is the timing of doing all of that? What are the amounts that you're going to be doing all of that? How much? What should that, we don't like the term asset allocation, and as far as, your portfolio, stocks, bonds, whatever. It's more of, well, how much can you set aside to be invested? How much should you set aside for these upcoming purchases that you have? How much cash do you need in reserves? Or, like we talked about last week, having a plan of, how to access cash and things like that. So again, the value of avoiding mistakes is so large, and a lot of people don't understand what it is. Oh, well, it looks like last year I had to pay some extra money on my taxes. Well, you don't know that you actually made a mistake, because there could have been something that you structured better. You just weren't aware of it.
Yeah, and these are all things that, again, people can talk to you about, and not just the first time. Because I know many times people do a financial plan, that's it, they never see or hear about it again. You're a fee-based planner, so they can do things, and 6 months later, a year later, Harrison, need to meet with you, or what do you think about this? Just a phone call. I mean, these are things that can really keep people from making these mistakes that cost them money long term. Because if you meet with somebody once, they'll never hear it again. With you, they're going to hear it over and over again.
And I mean, our lives are dynamic. The world around us is dynamic. Everything is changing all the time. So financial planning is really about putting you in a position to handle and make the right decisions as they come. And, as you go through life, you're going to come up with opportunities. You want to make sure you're taking advantage of the right opportunities, avoiding mistakes. And if you do that consistently, finances isn't something that you should have to worry about. There's plenty of other things to worry about in life. But, if we can make sure that your money is not something you have to worry about, that's really what my job is.
And I've heard people say, I feel so much better because Harrison's on my team now. I don't have to worry about things that I didn't know about because you know about them.
And I mean, I get that a lot. That's why my meetings take so long when I'm presenting something. I'm in there for hours because, there's so much to go through. And it'd be very easy if I just said, okay, do these things, but it's do these things and here's why. The why takes a long time to explain, but that gives people the comfort knowing that they really are making the right decisions. Because again, I don't have bias one way or the other.
Yeah, and that's so important, the why, because if you tell somebody something like, oh, yeah, they'll forget about it a week later.
Yeah,
But if you tell them the why and explain like, oh, that makes sense, I believe they'll be smarter financially because you explain that to them, you educate them, and they know you're always there for them.
Or to compound on that, explaining the why right when I do it, they might not understand exactly, how the numbers work, but when I'm explaining it, it makes sense. So that means when that problem or that issue comes up, they know they can always clarify it with me. Or if something else happens, well, what do you think about this? Well, let's handle that new challenge and make sure that you're handling it appropriately.
Great. Well, Harrison, thank you very much. Appreciate the input there and the smart topics as always.
All right. Thanks, guys.
All right. That's Harrison Johnson. He is our financial planner. He's a CFP. He's here with Wilsey Asset Management. He's a fee-based planner. If you want that free consultation with him, 2 ways to do it. One, call the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send an email, give them a phone call. Again, free consultation. People just love that free consultation because they learn so much, just not even when he's doing the planning, but just in the free part in the beginning. Like, well, my guy didn't do that. So, all right, let's talk about some banks here. Actually, one bank. We're going to look at Bank of America. Their symbol is BAC, and they're I didn't know this. They're not a money center bank. They're a bank diversified. I guess that's because they still own Merrill Lynch and some other things, I think.
Yeah, I mean, maybe sometimes the industry changes depending on what software program you're looking at, but
I'm not certain, but I'm pretty sure like JPMorgan Chase and Citibank, I think they're still in the money center banks, but I could be wrong. So, all right. Well, on the short side, it's only 1.5%, 68% institutional owned. That means a lot of individuals hold the stock directly. We do see a PE ratio of 14.4 versus 10.6. That's not good. Again, you want these valuation ratios lower than the industry average. Price to sales for Bank of America, 3.8 versus 3.2. Price to book value, 1.4 versus 1. And then price to tangible book value, this is better, 1.8 versus 5.6. It shows no price to cash flow, unfortunately, but they do have a PEG ratio, which is your price earnings divided by the growth, 1.2. That's pretty good. Nothing for the industry average. Now, over the past year, wow, their earnings are up 23.6%. That's above the industry at 15.8. Sales for Bank of America climbed by 6.1%, almost nearly double the industry as well at 3.7. The 5-year earnings per share growth estimate from the analyst looks pretty good for Bank of America, 11.1 versus a decline of 6.9. They do pay a dividend. It's not as big as the other banks. It's about 2.1%. The industry pays a 3.9% dividend. The payout ratio for Bank of America is 30.1%. So they could probably increase that if they wanted to. We do see, let's see here, on the quick ratio, current ratio. Oh, banks are not going to have those. Again, it's a financial company like an insurance company. But you do have the debt to equity, 1.2 versus 1.9. We also see that you have a net profit margin for Bank of America of 26.9. That is below the industry average at 29.9. Return on equity is low, 8.9. Usually on banks, it's lower than return on invested capital, which includes your debt. 16.9 is the return on invested capital versus 15.7 for the industry. Free cash flow is a negative 22.6 versus a positive 24.6 billion for the industry. And Chase, what do you got for the company going forward here?
Our current price here to start for Bank of America is $52.57. 52-week range. The low here, $33.07, and the high, $52.88. Year to date, it's done very well, up almost 20%, and 5-year return over 100%, 10-year return 208%. I don't have the ability now to kind of dig deeper into this, and I don't know why it wouldn't be accurate, but I look at the max chart on this, it's 53%. I mean, going back to
what? 53. 5,300 or just
53%. back to 1995. If you would have bought back then, you're only up 53%. And it looks like in like 1997, its all-time high was like $60.13. So it doesn't even look like we're back to that all-time high. I didn't know that for Bank of America, unless this chart is leading me astray.
I do remember back in the 90s, there was a banking problem. I remember at the time we sold Citibank at a pretty good price, and it dropped dramatically. So I think this could have been, with a change with them, they came out maybe at the peak, and that's why now there's 53%, and that probably does not include dividends.
No, it does not include dividends.
Because I do see the 10-year return on the dividends, which, again, this points out how important dividends are, but it's 304% with a dividend. You said 10-year return was what, 200 something?
111 or
What?
something. No. Oh, I'm sorry. That was the 5-year return.
Yeah, 10-year without dividends was...
You always do this to me. You always
I'm
throw me for a
sorry,
loop
you
after
try
I
to move on
moved
to the
on
next
to
thing, I
different
go
numbers.
backwards.
Let's see. 10-year return, 208%.
Yeah, so dividends make a big improvement for people.
Yeah, well, let's look at what we're paying for those future earnings. We got to December 2026. I see estimated earnings per share of $4.34. That would give us a target sell price of $72.04. The forward PE is right around 12 times. So, I mean, it is a buy based off the valuations. And I still think I wouldn't be over concentrated in the financial space, but I think having one of these big banks in your portfolio, again, you talk about a JPMorgan Chase, a Citigroup, Wells Fargo, Bank of America. I think having one of those in your portfolio, it still makes sense. I think it's not too risky to put one in there, but I am starting to, again, have some question marks around the financial industry, but there is still some positives remaining as well. If the economy continues to move along quite well, banks will do nicely.
Well, I know for, 2008, I mean, since about that time frame, I've pretty much held in the portfolio 2 banks. But as we talked about earlier in the show, so important with this NFDIs, private equity, private loans, I'm getting a little bit concerned on the banking industry. And the numbers look okay. But again, we talk about how those numbers could be masked by people that are just hyping up what they have.
And the other thing I look at, I mean, the numbers right now, as you said, very good. I mean, you look at Bank of America, they earned $1.06 per share. That beat the estimate last week at 95 cents. But one thing that's really kind of pushing these banks higher is strong investment banking revenue. And is that going to continue next year? We're going to continue to see the IPOs. We're going to continue to see M&A. If that slows, that could, again, reduce the revenue and reduce the profits for a lot of these big banks as well. So that's why, again, I want to be cautious around the space, but I wouldn't say eliminate the space as well.
Right. Be very careful here because, again, we talk about a lot. It comes from M&A, which we talk about new companies coming out. A lot of them have done well, but I actually saw, I don't know maybe it was CNBC. They showed a chart. A lot of these companies coming out, they go up and then down many times back below what they came out the IPO. So we're having more of that. So if that starts caving, they're not going to have the M&A.
They will have the IPO. They might still have M&A where companies buying.
No, usually that slows down too because they kind of get a little bit concerned. That generally cuts off the whole market. So everybody gets scared. They don't want to do anything. So.
I might disagree. I don't know. The M&A might still hold up all right because of the regulatory environment. People might still say, hey, we got the current administration that's looser on regulation. We want to push through M&A because we don't know what's going to happen in next year if the midterms don't go well. So I think M&A might be okay next year, but the IPO market, that might slow because of, as you said, if it's going up and then it's going down. I mean, I'm not going to IPO because it's not that healthy of an IPO market in theory.
Yeah, I just get scared all the way around when things start collapsing. And then we talk about the NFDIs. That could hurt to where it can just hurt everything, and all business will start slowing down. So you just want to be careful with the banks. I mean, we're pointing out things that, and again, we do hold 2 banks in our portfolio. We may lighten up on one next year. We're kind of getting a little bit concerned. We made huge profits since 2008, and it's just something that we're starting to be concerned with how loosey-goosey, that's a technical term, loosey-goosey things have gotten. So.
Very technical.
Yeah, very technical. Do you want to talk about, I like this one here because it's something that has to do with the economy. And you always kind of follow this one. I'm talking about manpower, which does temporary employment. And generally the thing has always been, I've been doing this for over 40 years now, is that if they're busy, that means the economy is doing very well. But if they start slowing down, then businesses are saying, we really don't need any extra help, we're not really hiring, that's when they don't do as well. So let's take a look at Manpower. Can't forget the name or the symbol. It's MAN, M-A-N. They're in the staffing and employment services industry. No surprise to me here. The short is 11.7%. So there's other analysts who think that, yes, this is going down. We're going to short this stock because we think it's fallen. Unfortunately, they have no PE ratio, which means over the last year, no earnings. The industry was at 29.1. Price to sales, very low, 0.1 versus 0.3 for the industry. Price to book value is 0.8 versus 2.1. But I do want to point out the price to tangible book value is 51.3. So that means they have a lot of intangible assets on the balance sheet. You got to be careful of those because if things don't go well, they got to write those down. And they say, oh, it's a non-cash write down, but it still takes down the value of that company. No earnings growth of last year. Sales are down 3% year over year. Now, the 5-year earnings per share estimate by the analyst does look pretty good. It's at 33.6%, but the industry is a negative 11.6%. They do have a nice yield of 4.4%, but remember, if they have no earnings, where's that money coming from? Are they borrowing that money? What are they doing? You want to be very careful when you see a payout ratio that's not material. Free cash flow payout ratio a negative 72.4. So that dividend, the other problem with that too is that dividend could be cut because they just don't have it. Business is slowing down, so be careful of that. I was kind of hoping this would be a buy, to be frank with you. On the balance sheet, current ratio 1 versus 1.4. That's okay. Debt to equity 0.9 versus 1.3. It's not too much debt, so they could weather a storm if one came along. We do see the net profit margin. Yeah, they're losing money. It's a very small amount. It's a minus 0.1%. The industry is a positive 1.2. Return to equity at minus 0.8%. Free cash flow a minus 70 versus 300 million for the industry. Just not very exciting here on this. I kind of thought maybe we'd find something good here, but it seems like a lot of people are not thinking they need temporary help right now.
Yeah, I was kind of surprised because last week after they reported earnings, the stock fell, it looks like about 7%, even after reporting better than expected results. It looks like they earned 83 cents per share. I know you said they had no earnings. Maybe that was earlier in the year. They had big losses to offset that. It wasn't a big beat. Analysts were looking for 81 cents, so again, 83, not hugely different. But the thing you look at is year to date, the stock is down 42%.
Oh, wow. I think that's why I thought, well, maybe there'd be something here.
Yeah. Over the last 5 years, it's down 52%. Over the last 10 years, it's down 63%. So, this stock has really, really been under pressure, to say the least.
You know, it's funny, over the years, I always kind of want to buy this company, but just never, the numbers never quite look good. I'm glad we didn't buy it down for a 5-year, 10-year. Gosh, never been a good investment, unfortunately.
No, there were times where it went up to like 100, but
Yeah.
it just kind of, you'd have to obviously time the market and get out at the right time, which we know is darn near impossible. And I'd be curious too, because it looks like they do offer, that recruitment services for permanent and temporary, but they also do offer some other services like assessment, upskilling, reskilling, career management, workforce consulting, and training and development services. So, I'd be curious what their revenue breakdown is, if it all just mainly comes from staffing or as companies are hiring them, again, in that consulting capacity to a larger degree. That might be safer revenue, less variable than that recruiting business.
And that's why before you invest in a company, we do read the conference calls, previous time frames, look pretty deep in the company, because you really want to understand what that company does. Because you mentioned some names, but how much revenue they get from it may be like 2% of everything. So you got to understand the business before you invest into it.
Yeah, and I'd be curious too with this whole HB1 visa situation where they're really lifting the price. It's like, would this actually help Manpower? Because our company is going to look for a consultant rather than bring in, outside help to pay. What's the fee? Like 100? I think it's like is it $100,000? Am I making that up?
For what? For
the visa? It's a one-time expense, I know, but
I'm not sure.
Yeah. I know it's a heftier expense than it used to be, where some companies, again, might look to alternative solutions. But anyways, let's look at the earnings going forward for Manpower. This looks decent here. You go out to December 2026, estimated earnings per share here, $3.82. You get a target sell price of $63.41. It trades at a forward PE under 9 times. But this is, again, where things get very interesting. Year over year, earnings are expected to decline about 37% this year. Then next year, you're looking for earnings growth of 33%. Is there some interesting accounting going on there to have such a large fall and then such a big gain in earnings per share, considering revenues estimated to be essentially flat this year and then up 3% next year with stable revenue? Why are earnings just all over the board?
And also, too, I did look at December 2026. So 90 days ago, they were looking for an estimate of 437. It's now dropped to 382. So they are bringing that estimate down. I think it might come down even further from that number. So,
I mean, you still got a buffer technically on the valuation, but
Yeah.
I still just wouldn't understand what happened this year to have such a large decline in the EPS.
yeah, I think the best time to probably buy manpower is when you're in a recession.
Yeah.
Because when right now there's a lot of people working and so forth, if you start laying people off or slowing things down, you don't need temporary help. When you need them is when you come out of that recession, when you come out of that slowdown in the economy. So not the time to buy it, unfortunately, and the numbers just don't say buy it.
I mean, the target sell price says buy it, but the other
That's right.
situations
Yeah.
does.
I think I was looking at something to get
Yeah.
a target sell price. I'm not going to ask you what it was again
It
because
trades at under 9 times earnings. I'll give you that.
See, and this is why you got to be careful, kind of like a value trap.
Yeah.
Because those numbers, that sounds pretty good. That's why I tell people, you can't do this in 5 minutes and say, yes, I'm going to buy this company. You're going to miss things. And yes, the 9 times earnings sounds great, but there's so much more behind that number that if you're investing, you have to spend the time to understand what's behind that number. Let's talk about Snap-on. I don't see these trucks around anymore. I guess maybe I'm not hanging around the auto parts
They're
places.
the blue ones, right?
I don't even know. I forgot what color they are.
I thought they were blue.
Yeah.
I'll look up their.
Yeah, you look while I give some numbers here. Company again is Snap-on. Symbol is SNA. They're in the tool and accessory industry. 5.1% short on the float. That's okay, but you don't want to go much higher. 95% institutional owned. PE ratio looks okay. 18 versus 21. Price of sales high. 3.6 versus 1.5. Price to book value looks okay, especially on the tangible book value 4 versus 25.7. And then price of cash flow is 16.5. That's above the industry at 12.3. Rather have that lower, not higher. And they do have a good PEG ratio, 1.6 versus not material for the industry. Now, over the last year, this seems to be the theme today. I think like most of our companies have negative earnings for the past year. Holds true with Snap, down 2% for the last year on the earnings per share for the last year. Industry is up 21.3, so something's going on with Snap there. And we got to be careful to say Snap because that could be the other one. So this is Snap-on. Snap-on. Let me correct that because somebody just turned in like Snap. Oh, that's the social media thing.
Snapchat.
Yeah. So this is Snap-on, the tool maker we're talking about. Sales up 0.2% for the past year. The industry down 8%. And they give a 5-year earnings per share growth rate from the analyst for Snap-on. 11.2 versus decline of 5.8. So that's pretty good. They do pay a decent dividend, 2.5%. They use 44% of the earnings to pay that out. They do increase the dividend. The 5-year average growth rate on that dividend is like 14.7%. So you like a company that's going to be increasing the dividends there. So I'm kind of liking this, but it really depends on what you say. You're going to ruin my company I want to buy here.
Well, it's kind of funny. I guess I don't see many of these trucks. Definitely not blue. Their
White?
symbols white with red.
Oh,
It's like
you were way
words
off on
are
that
red.
one.
Yeah, it's all right. But looking at the current price here for Snap-on, again, their ticker symbol is SNA. It's $343.93. 52-week range, the low here, 289.81, and the high, 373.90.
I didn't get the balance sheet information.
Oh, you go back and do that.
You want to do that? Or you want to wait till the end?
You go ahead.
That's right here. I'm sorry about that. I just thought it was your time to talk there. So balance sheet, very impressive here. Current ratio 4.4 versus 2.7. Debt to equity looks good, 0.2 versus 0.4. Net profit margin 19.8 versus 7.2. That's a huge profit, like 20 cents on the dollar for every dollar they bring in. Return on equity is 17.4 versus 13.3. Free cash flow looking good, $1.026 billion versus $692 billion for the industry, or $692 million for the industry. Now we can turn to you. I don't think I've ever done that since we were doing the show where I skipped the balance sheet.
It's all right.
Yeah, first time for everything. Okay.
Well, we look now going forward for Snap-on Tools again, or it's just Snap-on, I guess is the name of the company. Out to December 2026, this is the disappointing factor here. Estimated earnings per share, $20.51. Give us a target sell price of $340.47. So basically right along where it is trading currently. And I was kind of curious on this company. They reported earnings last week as well. And there's one thing that's interesting at the earnings season, right? You get so many different options of companies we can look at. But I guess they had a good earnings report. Earnings of $5.02, beat by $4.64. And they said they were really helped by a pickup in demand from auto part companies and repair shops. And I was kind of digging through their customers. They got a lot of different situations here. They have obviously automotive. They then have construction, electronics,
construction.
Manufacturing, oil and gas, power generation, military and defense, medical device manufacturing. So their tools are used in a lot of different capacities here, even vineyards and landscaping.
Vineyards and landscaping. Wow.
Yeah. But I mean, I do wonder, this company could be a benefactor from, maybe reshoring of manufacturing as, they need to retool or tool up those plants. So I was disappointed because I like this space. I think there's opportunity here, but again, the valuations are just a little bit too high. Maybe we're a little bit too late to the party.
And I also think too that I'm surprised they do all those other things, but it may not be a big percent of their business. We think with the growth of the economy, I'd rather have a more normal type of tool maker, not a Snap-on.
Yep.
So. All right. Well, gosh, unfortunately, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the newsletter. You can hear the podcast there, past things, a lot of great educational information there. Smartinvesting2000.com. Thanks for listening. We'll be back next week.